Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. For Kris Sidial, the Co-CIO of the Ambrus Group, trading and risk management is a passion. A self-professed math nerd in college, Kris began dabbling in sports using a statistical approach. He soon found his way into the options market, where he is now an active participant, but also a humble student continuously gathering knowledge from his interaction with the markets. Through our discussion, we learn of how Kris thinks about flows, his analysis of positioning, and the complex poker game that leaves him always evaluating the why of the actions of others in the market. In his view, the market has become more reflexive over time. Here he cites not only the volatility of the meme stocks, but also the substantial growth in products written on volatility itself and the huge growth in short-dated options trading. Kris observes changes in the market microstructure over the past few years that leaves the market leaning heavily one way or the other and creating very large bursts of volatility that come suddenly. It is this dynamic that he and his partners at Ambrus Group are trying to capitalize on. We also spend time exploring the beta relationship between the VIX and S&P. Here again, Kris points to the proliferation of volatility products as playing a role in the outsized moves in the VIX that have become more common over the recent period. Lastly, we talk about managing the reality that options bleed premium. In this context, Ambrus engages in medium-frequency strategies that seek to cover some of the theta built. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Kris Sidial. My guest today on the Alpha Exchange is Kris Sidial. He is the Co-CIO of the Ambrus Group, a firm that specializes in trading options. Kris, it's great to connect. Thanks for taking up the invite to be on the podcast today.
Thank you so much for having me, Dean. I really appreciate it. Glad to be here.
Excited to have this conversation with you about markets, about vol and trading technology. So why don't we get started from the beginning? You've got a great background. You've moved quite quickly through the industry and done a lot in a short period of time. Tell us about the beginning, the start for you, and what it was that sparked your interest in finance.
My beginning is very different than your standard Wall Street fund manager. So I was actually a math nerd. So that's one thing that line. So it's part of the math Olympiad my entire life. I always had a love towards statistics. And so I always had this view that life functioned in this Gaussian manner, even though we know that that's not true. But early on in my days throughout high school, I fell in love with sports gambling. And at the time, I was a really broke kid. I didn't really have much money to apply towards sports gambling, but I tried to use these forms of statistics to apply statistics towards gambling. And of course, I failed. I'd make a little bit of money with my friend here and there, but net and net, those type of things don't really work too well. I started my undergrad, and throughout that time, I was an accounting major, actually. I gravitated over towards using that same form of statistics towards markets. So thinking about markets and generating returns based off statistics. So I went through the same process as every other young trader. You fail a million times until there's a light bulb that goes off. And I graduated college. I had my first real opportunity trading vol under one of the ex-guys that helped started the CBOE. His name is Bob Cantor. Bob really instilled that framework and that ground as to what it was like to really run a vol book and trade vol from a speculative manner. The time that I spent with Bob, the time that I spent trading, even before when I was a bad trader, it just kept igniting that love for the game, the art of speculation that came with it.
It's interesting, and I'd love to learn a little bit more about those early days and your introduction to trading vol and the time frame. But I'm sure you've come across these folks as well, but there are some people who say, I will never sell vol, ever, under any circumstances. And then there are others who say the exact opposite. I'll never buy an option. I don't like the decay. There's the old saying, sell the straddle and go to lunch. And so you see both sides of it, and you can be effective on both sides. What time frame was it that you got started in listed options?
For me, I would say probably about 2014 or so. Before, when I actually got into trading, it was more so from a Delta One standpoint. But about 2014 is when I started having this view that you could use options to express that view. And of course, like every quant, I fell into the realm of the trap that every quant falls into, where you think about selling Vega and martingaling your way down some sort of short vol position based off of some sample size that you're running. So I'm just like, oh, this is 5 standard deviation move. I'm adding to the losing position and I'm martingaling and doubling down. And so I fell into the same trap that every young quant fell into early on in my days.
As you got into options, 2014, where post the financial crisis, there were tremors along the way. You had the sovereign crisis in Europe in 2012 and 2013, and 2015 was China. But that was kind of a low vol period, at least at the index level, for a couple of years. What was that like just in terms of that period for you? And did the time frame tend to impact how you thought about volatility, since it really wasn't very significant over a couple of years where you got started?
So I think at that point, I was still going through the motions as a junior, the motions as an individual who's thinking about generating alpha using options and the edges that come with them. I think the way how I viewed things back then is significantly different than how I view them today. A sample set back then, the way how I viewed it was completely changed as to how I view markets now. Today, I'll tell you, markets function in this sort of like large Markov type of process where things are dynamic and it's driven by large interactive agents, and positioning is a very big factor at play. Back then, I was still going through the motions and focused on really head first into the data, not really understanding directly what the data was telling me.
You started with some background under Bob Cantor in listed options. You also spent some time on the sell side managing or helping manage a book of vanilla exposures, but also some exotic exposures. I'd love to learn a little bit more about that period for you and then what you took away from it.
This is something that I think is quite special. I was definitely blessed to have exposure from all different angles of the business. When I was under Bob, it really molded my mentality to think about trading from a speculative standpoint, being an alpha generator that will go out there and generate profits. So that was my first real mold and framework of thinking is, how do I go out into the market and pretty much eat what I kill? So that mentality took me over to the prop side. So I was at Chimera Securities as a prop trader for just a short period of time. During my time there, I learned a great ordeal about order flow, understanding how order flow really works, and trading flow and trading intraday flow, and putting together those things that I learned with Bob and putting together the order flow dynamics as to how large systematic flow impacts markets, and then also smaller flow and how to really generate alpha off of that. From that point, I went to a small buy-side equity hedge fund that was doing some event-driven stuff, a little bit of kind of a flavor of some stat arb stuff as well there. And then I went to BMO, which was a very large Canadian investment bank. Most of my time there was spent on the exotic derivatives and listed options desk. And the book size there was just a big jump. I went from going about thinking about markets from a speculative view, again, eat what you kill type of mentality. Can I go out there and can I generate alpha and make money? To now you're on a team with other individuals that are managing this really large exotics book with a tremendous amount of path dependency, and making sure that, one, you have some sort of an edge by creating or pricing this thing correctly and trading the vig off of it. And then two, pretty much hedging a humongous book like that and making sure that if market slides down 20% in 3 weeks, the bank's not going to blow up. Are you capturing that edge? And at the same time, are you pretty much protecting that edge for the bank? So I think what made my process so different than everybody else's is that I got the opportunity to see all these different flavors. I know what it's like to be a trader that trades on the prop side to generate alpha. I know what it's like to be a trader that trades on the sell side, to go there and act as a market maker and trade flow as a market maker, and then also price deals and be a hedger for the bank effectively. I think all these paths that I've been very fortunate enough to go through has given me this very holistic view where I could now identify market participants and the reasoning and rationale as to why they act a certain way. On the sell side, right, I was able to see tons of flow, and whereas on the buy side, I wasn't able to see that flow because I'm giving that flow. But when I'm taking that flow in from the sell side, I have an understanding to know this is what this guy is seeing. That's why he's putting it on. And if I know that, I could react in a more different way because this is the same thing he's doing. It's almost like a game of poker, right? I understand why the other player is laying down that card or why they're playing aggressive or they're playing a little bit soft. So I think that has been the most special thing about my career is that I've been extremely blessed to get a flavor of all these different pieces to now bring me into this, what I would like to think is kind of a holistic trader.
The sell side trading role is an interesting one because certainly on the flow side, you don't really have too much of a choice to participate or not. You do have some implied obligation to stand up for client flow and try to be a part of it. There's only so many times you can say no. That's kind of part of the process. And then on the more structured side, and I'd love to get your take on this, because something you said about observing the flow got me thinking about pricing deals and trying to avoid the negative selection that you could win any deal you want. It's just if your price is that good, you're going to win. But then, as you noted, the ability to preserve edge, if there's any left at that price, is going to be very difficult. What was that like, just in terms of pricing complex securities, complex structures, trying to win, but not win by too much? Take us through the game of poker from that context.
This is really a team thing, too. I don't want to make this seem like I was the MD at the end of the day calling the shots, because that definitely was not the case. But from an individual trader standpoint on the desk, your boss is going to look to you to know, okay, you could hedge off this risk or you could price this way. But at the end of the day, you have some of those clients that you know is a client that will come back and hit the line. So sometimes you're going to price things more aggressively in terms of their favor because you know net and net that this client is a big client in terms of commission and we want their flow. So if it means that I kind of got to take it on the chin and pricing this one to give them a good price because they'll come back and tap the line with us 3 weeks from now on another deal, I'm going to go ahead and I'm going to do that. And I think that's the side of trading that a lot of the traders at home, retail traders, or even some institutional traders don't really understand too much, is that plays a big part in the decision-making process. Is like, how good of a client is this to you? Are they giving you big commission numbers? And if so, you're going to be more favorable towards them. There were times where you had to be more favored to lean to a certain client because you didn't want to aggravate that client, because at the end of the day, if that client starts taking their flow elsewhere, then it's going to be net and net, or long run, it's going to be a loser for you. So it's sort of like, pardon my analogy here, but I'm going to take these like small punches because I know net and net in the long run, I could kind of get a knockout punch. And that was really the view. So there were days where you had to really manage that. You had to manage, I'm going to price more aggressively towards this client today because I priced loosely towards them last week, and really just toggling that back and forth. And when you think about the exotic structures, these are very big, complex structures with multiple path dependencies. So, and at the end of the day, you do have to look out for your well-being. And when you think about putting up deal sizes that are 50 million or 100 million or so in, let's say, 3-year Vega, it's a lot at play. Everybody's very hands-on when you have these big deals that flow in from the clients. But net and net, as the trader, it's your job to also understand the client relationship and to know there may be some times where I could be aggressive and there's some times where I could be a little bit loose, but all for the good of the long run.
It's interesting to think about just how different some of these structures are in the market that we operate in daily. It could be the one-day Apple call, and you're referring to 3-year highly exotic structures. They might have multiple underlyings. They've got lots of features to them. The risk characteristics are just so much different. So you've seen a fair amount of different kinds of structures. Let's talk a little bit about trading technology and market microstructure. So from, let's say, the last 5 to 7 years, I mean, everything's just gotten faster, better. There's more securities. The accessibility to data is like never before. new data sets and the ability to harness them is incredible, just given the computing power. Just walk us through maybe high level first, what that's meant for you, your observations and how that's become maybe a part of your trading process or risk management process, specifically the changes in technology and market microstructure.
That was the reason why I left my prior role, was because of that specific reason, the way how the market microstructure has changed, specifically over the last 3 years. It has been one of those changes that has not been linear. It's just been an exponential change where you slowly start seeing something happening, and now we're at this point where everything is completely different. So what you're saying too, the technology, the ability to get data from different forms of alternative data and play with the data and understand the data and manipulate the data and use that to your advantage to create or harvest some sort of an edge. And I think the structural changes is something that I speak on quite often, and it's very evident. And it's almost surprising to me that not too many people are seeing these same things. So like the reason why I left the previous firm to start up this firm was because collectively, myself and the other partners believe in this reflexive market. We believe that we are in a regime that because of these structural changes, you will see a market that is only lean one way. So what happens is the market is very reflexive to the upside. There's this constant strong rally that takes place. Things are risk on. Everybody's somewhat taking the same trade. And then at the exact same time, when things go risk off, everybody's looking to deleverage and exit at the exact same time. And this creates these very big bursts of volatility throughout this period. So it's like prolonged period of low volatility and small little pops where the equity markets are rallying, and then you'll have this big burst out of nowhere of big volatility. And because of that dynamic, we said to ourselves, well, can we structure something around there where we could generate alpha? And that's why we started this fund, specifically for that reason, to say, well, can we make 200, 300% during moments of risk off, during moments where everybody goes risk off? And at the same time, can we run strategies that don't carry that underlying basis risk to standard equity vol and run some sort of medium frequency type of strategy that generate alpha that can offset that bleed? And if we can do that, we have this sort of pure book. So when you're thinking about the structural changes, they come from a ton of angles, where it's one, we have to talk about the growth of derivative exposure. And the specific type too. Everybody is trading short-dated options. The way how short-dated options have increased, it's insane. Everybody is an option trader today. So that adds to the reflexivity from that dealer gamma hedging dynamic. Then you think about the growth of passive, where we have ETFs inside of ETFs, and there's more ETFs that are linked to names, and the rebalancing process from one name is affecting the other name, and that's linked to one stock. So it's like this big cobweb where everything is somewhat interconnected. And then you think about the structural dynamics of these target date funds that need to generate returns. So systematically, what you have is every Wednesday, here comes a target date fund. We need to buy X million amount of Apple. That's driving the market up. And then when you think about how the other participants in the market react, they're engaging in the same type of process, the CTAs, the long short equity funds. And then you think about the growth of structured products and how that adds to the reflexivity with the need to harvest yield. And it's almost like, the way how I look at it and think about it, everybody is somewhat taking the same trade in the same direction. It's almost like one of those old school cold trains where you have 100 people that's on top of the train, and the train is like moving side to side, right? And everybody's just trying to stay on the train, but the train is going really fast and going really straightforward. So everybody's making money at the same time by inherently taking the same type of trade. And they don't realize that these trades are all interconnected with the same thing, which is synthetically just long the market. And what happens is that everybody thinks that they have a smart game plan in terms of saying, okay, well, when the train starts slowing down, that's when we'll hop off. But what you get is that everybody looks to hop off at the exact same time. You think about the way how a lot of these long short equity funds and CTAs, and I could go on and on and on about different types of fund structures that operate in the same manner that say, when markets go down X amount and volatility goes up X amount, we're going to cash. Everybody has that same game plan. And then what happens is that the liquidity providers, and we think about the growth of technology, like what you were saying, the liquidity providers, again, we know there are only about 4 true real liquidity providers. When things go risk off, they're trying to protect their book as well. So what happens is they're using technology, which is much more advanced than the guy sitting at home, to go out on screen and pull liquidity really fast. But so when you have the role of what liquidity providers are supposed to do, they're supposed to add liquidity during those risk-off moments. But what happens is that everybody's somewhat in the same page where they need to make money. So you think some guy's going to try to step in front of that flow that's falling against him? No, he'll widen out his markets. He'll make money on the spread by widening out his markets. But the market makers themselves, the liquidity providers, they won't act in that capacity during true moments of market stress. And when you think about all of those things happening at once, you could understand why you have an environment like March of 2020, which a lot of people think were mainly driven by the fact that COVID happened, which again, that was the straw that broke the camel's back. But the structural flaws that were at play at that time was a lot more than that. It was the whole the piling on systematic short volatility along with all these type of systematic structures, and then the deleveraging at the exact same time. And now when you look back on it, you're like, wow, imagine what would happen today if that happened, based on the fact that there's now more leverage at play. And on top of that, you have the same type of systematic processes and the growth of more people using options more so now than ever.
Yeah, you got a lot of great stuff there. And certainly the data would support the notion that the market is subject to more spasms. It's a 10 realized to a 25 realized back to 10 in a short period of time. The cycles of vol, both implied and realized, seem shorter. They're these bursts, as you call them. And I certainly am in your camp of, I think there's something about the trades themselves that live and breathe within the market that have too much commonality and are, as you said, they add this reflexive element to it. Let's talk a little bit about this year, because you say post-pandemic, that obviously was a shock, and we'll never know exactly how much of that was, well, we shut the economy down, there's going to be a lot of vol, versus, as I think you very rightly point out, there was vulnerability going in just with respect specifically to short equity vol. But post the pandemic, and perhaps it's people at home with some extra cash, but this surge of retail interest in options is just extraordinary to watch. And you've got a real bird's eye view in it. You're staring at this stuff and trading into it and against it all day long. Walk us through the last 18 months. Just, again, start maybe high level of what you have seen with respect to changes in the listed options market, the retail participation. Give us a flavor for what you've observed.
One thing that I'll say that matters tremendously, and we'll touch back on this later, is the growth of structured products. The structured products market in the U.S. has now trumped Asia, which is a big deal because people don't understand that there are financial advisors that are putting hundreds of millions of dollars to work for clients every single day in these types of structured product deals. So that's one thing that people need to understand is going on. And I'll explain why inherently this replaces the whole short vol variance swapping later on because of the inherent hedging that comes with some of these processes. But I think the thing that we noticed as well is that you have this growth of option users, and everybody's somewhat an end user in options in terms of the people that love to go out there and buy 2-week vol or 1-month vol. A lot of times these people don't really even understand the vol components, so it's just option buyers. We just want to be buyers of options because we want tons of leverage. And I think what we've seen throughout this year really affirmed our thesis from all different angles. Start with the whole GameStop and AMC thing. When that transpired, we actually did well in January. We printed, I think, 3% or so, which for a vol fund like ours is a really good number because we more so focus on tails. So ideally, we should be like flat. But during that time, we were able to allocate a small amount of risk to these type of plays because our model picked up on the fact that, look, there's a positional imbalance that's occurring in these areas. So we threw towards there like a little amount of risk And this reflexive dynamic as to how options can truly expand the underlying name, it was just so affirmed during that process where you've seen this thing go through the roof. All these names go through the roof because of the gamma hedging impact. So that was one of those times where my partner and I were looking at each other and we were like, wow, like we knew it would be crazy, but we didn't think single names would be this crazy or could get this crazy. So it was not good that people lost money or the processes throughout that, but it was good to see our thesis reaffirmed when put into action. And then we continued to see the market do what it does, which is volatility got suppressed, and we got back into that regular environment, which was expected. And then there were a couple things more so recent that continued to reaffirm our thesis as well. What we were seeing, and I think the date was November 22nd, market was trading at all-time highs. And then within a span of 1 hour, it deleveraged more than 1%. And it really brought us back to thinking like, look, this market could move 1% like this in an hour. What is stopping this market from going down 20% in a month or a month and a half? And it's one of those things where it's easy to stand by the thesis. And then when you see it, something like that, and you're trading on screens and you realize like, wow, this is pretty impactful. Because you go through these periods of time where you forget how crazy volatility could really get. And this is what's special about this product is that it could lull you to sleep in a way. So you're so used to seeing something trade at a 10 ball. And then when it goes to a 15 ball, you're like, oh, wow, this is moving. But in reality, like these things could trade at an 80 ball or like a 90 ball. It kind of lulls you in a way. It's fooling because obviously volatility is mean reverting, but at the same time, it's clustering. So when you get in these low vol regimes, it can kind of fool you. And then when you get that big ball pop, it's like, wow, here we are. We're playing a game that we knew could happen. But I think the final thing that I would say that was one of those things that we were and are still kind of pounding the table on is the VIX to SPX beta relationship, which is something that's been extremely strong. And you have to think about what structurally has changed in the market and how that impacts VIX pricing. When you think about what is VIX pricing, it's all predicated off SPX 30 to 40 something day options. That's really the tenor that matters when you think about like how VIX pricing is derived. So when you think about the growth of derivative exposure, which is, okay, now more people are trading options, now more so than ever. And they're focused on short-dated options. More so, they like trading weeklies and things of that sort. But the 30-day vol in that area has definitely gotten a bid as well. People have an appetite for that. So when you say to yourself, okay, they're more actively trading that, and then now a lot of those end users are liquidity takers. So when they're pulling liquidity, obviously that has implications on fixed pricing as well. So it's hard to see that there wouldn't be a change in that VIX to SPX relationship. And our belief is that during moments of market stress going forward, you'll see this big impact on the structural changes affect the way how VIX pricing works. So our belief is that during the next true deleveraging moment, and when I say true deleveraging moment, I don't mean the market down 2% in a week or 5% in 2 weeks, like a true risk off moment, you'll see VIX pricing get insane. And I think one thing that matters too is the way how the market and all the other users in the market use VIX as a part of their risk calc. So a lot of funds have this way of saying, okay, if VIX gets to here, we want to look to deleverage. Or if the market goes down X amount, right, or VIX is here, volatility is here, right, we want to deleverage. Because it's like one of those things where volatility begets more volatility. And it's like, if VIX gets to a certain level, some people are going to start deleveraging, which inherently creates this big reflexive whirlpool where volatility goes higher and higher. And I hate to sound like Chicken Little. I hate sounding like that guy who's like, oh, markets are going to crash, the world's coming to an end, because that's really not our view. Our view is we believe in being bullish the U.S. economy, bullish U.S. equities, but doing it in a responsible way and having some sort of a true hedge to protect your overall exposure. That's really our view that we try to get through our clients. But when you see all these things and you understand the structural changes and how it could be very reflective like that, when you start seeing things like the VIX to SPX beta relationship expanding on little small pullbacks like this that we're seeing in the market, it just keeps reaffirming our thought process to say like, yup, that's exactly what we expected. So imagine a moment where the market goes down 10% a week. You can't expect VIX to react today, that shock down 10% a week, the same way it did 10 years ago, because it's a completely different environment, completely different regime. And there's so much velocity in this market that when you have something like that, vol is just going to get taken to another level, in our opinion, at least.
Yeah, you make the point that there's a certain sticker shock that sometimes infiltrates people's thinking. I'm staring at vol and it's 10, and suddenly it's at 15, and that feels really high. But as you note, these prices can come out of nowhere. You could get to 80. The prices are just where two people found a way to come to the table and transact, and that could be at mind-bogglingly, sometimes high, and also sometimes low prices. But it does feel like we're in this regime of higher vol. I mean, just graph the VVIX over a long, long time period. It's only gone up with fits and starts, but it's higher than it used to be. And I do think that's in some ways due to just all the product that's built around it. Those are some really good insights. Let's talk a little bit more about this vol beta, this S&P and VIX vol beta. I guess the biggest beta event for the VIX was the XIV unwind in 2018. But there's been others, and I think this year is one in which there's been several days where the VIX has outperformed its implied move by a tremendous amount. But I just love to hear more. You're staring at this stuff. Talk us through a little bit more about how this vol beta is a part of your strategy and what your observations are on it.
We wrote an investor letter to our investors the day that the CBOE went live with saying that VIX is now traded 24/5. So now VIX and SPX options are now fully accessible at any time of the night. And we had a thesis about why we wanted to increase some of our VIX variance bucket and some of our exposure. I won't go into tremendous details about some of the implications towards that. But long story short is that we believe that this is one of those relationships that people are going to look back on, and it's not going to be the same as to what we've seen 5 years ago, 10 years ago. And they're going to say, wow, this makes a ton of sense. Because again, when you think about the way how it's almost like levers, if you think about one lever being pulled, affecting another lever being pulled, that's exactly how this works. Where, okay, you have more people now trading a specific tenor of options in an aggressive liquidity pulling type of fashion. What's going to happen to something that bases its calculation that's directly from that? It's almost like a domino effect where, okay, more derivative exposure, more end users that seek to pull liquidity during these moments. Well, what happens to the thing that it bases its entire pricing on that? And when you think about this, it's like this big domino effect happening there. And then you think about, okay, so if that gets to a certain level, what other implications are there? And then it goes back to what I was saying with the whole risk model thing, where so many people view or polarize the VIX in this fashion where they look to go risk off if VIX gets to a certain level. And there are people who are not volatility traders or derivative traders. They're just long-short equity, CTAs, or whatever, right? Everybody has that type of same switch where they say if volatility gets to a certain level and if the market's down a certain amount, we don't want to, like, this is a hazard time for us. And if you think about those funds deleveraging, then it's just going to add more volatility and it becomes this reflexive dynamic. So from what we're seeing on screens is something that is just reaffirming our belief that VIX pricing is going to continue to be affected based on the growth of the derivative exposure. And if you can inventory cheap variance in some of these buckets, specifically in short, we ideally play 1 to 2 month vol. That's our belief. Our belief as a firm is that can we be in the area that offers the highest payout profile? Because that's what we really serve for our clients, is that if markets fall apart, we want to be able to generate 2x, 3x, whatever the shock profile is of our book, because we're specifically tailored to that. If we're tailored to that, we want to be in that 1 to 2 month vol bucket. That's really our focus And we're saying to ourselves, if there's cheap fixed variance in those type of buckets, whenever you can inventory and get your hands on them, specifically tails, that's our belief, you should be inventorying some of these things because it's one of these environments that is like, you'll see really low volatility, and then when things hit the fan, it can get very, very stretched, even with minuscule moves.
Even if you're a believer in the value of convexity and how it can save a portfolio during some crisis event, paying the freight in the meantime is always on people's minds. Those periods in between episodes of risk off can be long, and they can be tiring and costly from a carry standpoint. You alluded to some of the work you guys do on the offset side. I'd love to learn a little bit more about how you think about the financing side of things, where you can safely earn some carry in order to get long the things that you want to be long from a convexity standpoint.
Here's one thing that I will say to listeners. There's that very famous saying, theta pays the bills, but convexity gets you rich. But theta pays the bills, but gamma gets you rich. It's true. So if you're thinking about being a retail trader, let's say if you're a retail trader or a family office that's looking to generate alpha, you're not going to have 100% of your portfolio an opportunistic tail type strategy like something like ours. That's just very unrealistic and kind of stupid. You need to have strategies that are going to be there to perform. So when you think about overall portfolio construction, you would only use a small part of your portfolio to allocate to a strategy like ours, like a very small part of it. And you would have your other things that are out there, your long equity exposure, your long gold exposure, crypto, whatever it is that you believe in. But when you think about the construction towards this, our view and how we went about creating this, we said to ourselves, okay, what is really messed up with tail risk? Like, what's the problem with tail risk? And one, we think it's the application. So a lot of tail risk funds apply this like systematic way where they're just like, okay, every Wednesday I'm going to go buy 6-month SPX puts and then roll them. But it's like, that's not really an effective structure for a client. And there's no alpha there. That's just a generic trade structure. I try to make sure I get this point across to people when I explain to them that there is no alpha in a straddle. There's no alpha in a ratio. There's no alpha in a condor. Those are all trade structures. That's not a strategy. It's a trade structure. So if I'm just going out there and putting on these like generic trade structures with no underlying alpha behind it, you're going to get these type of poor results. That's why tail risk gets this bad view. But if you can do this with more creativity and more care, the same way how you would go out and be buyers of Apple. Let's say if you're running a fund, you have an investor and you're like, yeah, I'm buying Apple, and the investor gives you $100 million, you're not just going to go and any random price just buy Apple, because they'll probably fire you. The same way when you're applying tail risk and opportunistic tail risk, you shouldn't just be systematically going out there and buying. You have to think about these things in a more creative way. And the execution process is a big factor. And then the bleed control is a big factor. That's where a lot of tail risk funds get it wrong, because again, they're using this like static structure where they're saying something like, okay, I'm going to sell a straddle and then I'm going to buy 10 5 delta puts, and that's it. But like, you're carrying a ton of belly risk there. There's basis risk if you're trading SPX vols against single name stock vol or something like that. And I think what we said to ourselves is, okay, how do we do this in a way that we can generate alpha and avoid that bleed, or try to avoid that bleed? Because when you're running something that's long vol like this, some sort of negative drag should be expected. Our view was that, can we offer something that has a huge payout by running other strategies against this that are more so medium frequency strategies that will mitigate the bleed and not carry some sort of basis risk? So we have 3 different sleeves that we run. One is only directly correlated to S&P vol, which we're very tactical in our approach there. So it's not like saying we're going to just sell a straddle and Vega weighted sell a straddle and then buy vol on 5 different single names. We're doing something a little more bespoke than that, where we're saying, okay, can we take advantage of these type of selective strategies that are run at a medium frequency base, generate alpha, kind of think about things in a pure alpha standpoint, make money on those, and then kind of use it to fund all the tails that we're buying. It's not like we're just selling a straddle for clients and just saying, yeah, we're selling the straddle, that's how we generate alpha, because that's not true. But can we tap the line and trade flow on an intraday level and say, okay, we understand there's edge in trading flow on this specific strategy. We could make 20 bips a day doing that, the same way how on the prop side of the business, guys go in and they trade flow. And can we take those 20 bips on a daily level and say, okay, let's extend it and buy some tails across the board? And can we keep doing things like that? So when the client looks at their portfolio, in a perfect world, they would be, if markets are up, they are making a ton of money in all their equity exposure, and they have a lot of long skew and long tails with us, and there's no real bleed because we have been generating alpha from these other subset strategies that we're running to mitigate that bleed. That's kind of how we look at this type of profile. It's a little bit different. So it's not like it's like a systematic tail risk strategy, and it's not like it's completely long fall. There's a few other factors at play. So that's kind of why we think of it as more so opportunistic tail risk, if you want to call it that, where we have a thesis that this market could be very reflexive and we'll be buyers of tails in 1 to 2 month vol. But at the same time, to mitigate that bleed, we can use these type of medium frequency strategies to kind of mitigate that bleed that comes with it.
If you're generally in the market buying the tails, you do really have to find some mechanism for offset. And I think it's very interesting what you guys are doing. You'd mentioned flow, and we talked a little bit about positioning. And this tends to get a lot of attention these days. Where are the gamma pockets? What strikes are relevant? What does the expiration bucket look like? I'd love to hear more about how that fits in to how you think about the reactivity, I guess, at certain points in time as the market moves. How much data are you able to get just from the listed space? Are there other alternative data sets that you find value in trying to piece together this whole mosaic of positioning?
We've definitely toyed around with the data quite a good amount. I'm always trying to go out there and find different forms of data. So whether it's, can I get all the exotic structures that printed on Tesla or something like that? And then I could figure out, or at least try to figure out a hotspot where structured product exposure, some of the hedging standpoints and hotspots could be from that. That's a very hard thing. I can't say I have any statistical significance behind doing that, but it's some of those good practices where you want to at least have an idea to know that, okay, this huge exotic deal was struck on this one name. Here's what I'm looking at. But in terms of the single stock side, which is what we tend to focus on, we could go in and obviously we have our data providers that I won't speak too much on, but there are data providers that will give us the data, and then we're going back in, we're recalibrating the vols, and we're kind of going print by print and kind of figuring out, okay, this print that hit the tape, are dealers short vol here, or are they long vol, based on the way how the term structure changed. If a dealer was under pressure there, you'll know based on the rate of change of vol in that specific hotspot. And that's something that we do when we try to figure out to say, okay, if we understand that, and I'm just saying this for easy following purposes, if we understand that a huge print hit the tape on, let's just say, SPY, huge print hit the tape on SPY, and we know that dealers are short at SPY 400. They're short a ton of balls at that point. And we go in and we look at tails and we say, okay, we understand that tails at SPY 370 we could get for a price that we feel really happy about in terms of the amount of notional and the amount of convexity that we could pick up. What we would say is, what's the probability of SPY getting to that 370 range if it breaks that hot spot that is at SPY 400? And we kind of look at the market in this like Bayesian format where we say, okay, here's conditional probability, like conditional probability 101, where condition A happens, what's the likelihood of condition B happening? And if I could get favorable pricing on the market discounting condition B, then that's where I want to be buyers of cheap tails and cheap skew. So can I figure out where the hotspots are? And can I be buyers of tails points down from where that hotspot is, because I understand that if it gets to that hotspot, there's going to be significant deleveraging based on that.
When you think about your book and how you construct it, it seems a lot of attention is paid to, again, the internals of the market, derivatives as a source of acceleration sometimes, and sometimes maybe muting vol if there's long vol pockets that people are sitting on. But then there's also this big global macro story that's unfolding, and the center of it often is the Fed, and the Fed seems to be very much in transition. So I was hoping we could just look ahead a little bit and think about 2022. And I'm just curious, as you think about your strategy and have discussions with clients around what to expect next year from a vol standpoint, how much or how little does that big global macro story, as it might unfold, come into the conversation?
In the vol community, I know there's a heavy focus on like positioning, which is for good reason. This is the market that we're in, where positioning matters a tremendous amount. And it's one of those things that it's going to impact your P&L whether you acknowledge it or not. But I try to also put myself to understand that there are these other thematic flows that exist in the market, and we're at a time where it's really important to acknowledge those things. For the first time, we are seeing a true hawkish Fed in a time where inflation is a problem in the U.S. I think it's quite evident now. I was one of those people that was in the camp that I thought it was kind of priced in to say, like, all right, didn't we know that, like, there's been so much pent-up demand that there will be inflation? But I guess I was wrong in terms of thinking how the market will react to that. But I think you really have to see what the Fed is going to do and how aggressive they're going to do this. Because it's easy to just say, it's easy to just poo-poo on everything the Fed's doing, right? Yeah, the Fed will be supportive towards equity markets, which I agree they will be. I think U.S. consumers and U.S. consumers' savings are so tied to U.S. equities that the Fed understands that they can't let U.S. equities go to crap. There will be governmental intervention. They need to be supported towards U.S. equities. But to the extent as to when they're willing to pull that trigger, that's something I'm not sure about. But I want to see how aggressive they will be in handling the rate hikes and the balance sheet control going forward if the inflation theme continues. And I think that's a big point to note, because whether we want to believe in this or not, there are other structural dynamics at play here. And all that it takes is a council of a huge pension fund to say we need to start trimming some equity exposure based on the fact that we don't believe that the Fed will be supportive of U.S. equity. And then now, what you generally had of $50 million and let's just say $100 million in weekly flow from one firm now goes away. But now say that happens to like 10 or 12 or 15 firms. That means that constant bid in equities won't be there if the market perceives it as that. And this is something I just don't know. I don't know that some of the target date funds and pension plans will stop doing that, because at the end of the day, they need to generate returns because it's in their mandate. So maybe they're just going to say, it doesn't matter. We have to put cash to work and we're buyers of U.S. equities because there's nowhere else to hoard it no matter what. That could be something as well. But I think I'm at that point where I want to see more data and I want to see more information before I really make a call to say, okay, we're aggressively thinking that this year could be a sell-off. Because as of right now, I still think that people should be thinking about markets, and specifically equity markets, in a bullish manner, but in a safe way, a structured way, the way how we're kind of saying, where you should have some sort of tail protection and you should have a diversified, balanced portfolio. You should think about portfolio construction from that standpoint, but you shouldn't directly just be in cash on the sidelines. So for us, at least, I would love to see a little bit more of that before I'm able to really make a call in terms of going into 2022. The only thing that I could kind of stand by right now is that if all things remain the same, I think these structural dynamics will remain at play. And I think we'll continue to see that market that continues to grind up, everybody's risk on. And then during moments where things go risk off, everybody's kind of hitting the fan at the exact same time. I think that's the environment that we're in. It's very hard for me to think that we'll be in an environment where the market will slowly drift down and vol will slowly grind up. I really don't see that in the cards anymore, me specifically.
This last 4-ish% drawdown, not the last 10 days or 12 days or so, but the period beforehand, it was kind of like the shot heard around the world. I mean, I've never seen so much trepidation from such a small drawdown from the all-time high. And it just kind of tells you that all may not be well. People certainly get quite nervous very quickly, and maybe for good reason. Well, Kris, I wanted to finish up our conversation and hear a little bit from you just around what inspires you. You're a great presence on Twitter. I've really enjoyed following and reading a lot of your inspirational commentary, a lot of it directed towards your love of trading, your passion for markets. Tell us just a little bit about where you find your inspiration. What gets you really excited? Love to hear a little bit about that.
I think I'm a little bit of a weird guy for a few different reasons. Inspiration, I wouldn't say I really have one direct thing that I could base to. There's a few factors in my life. I'm a religious individual. I'm a Christian, so I kind of lean on that quite heavy. My faith is something that I stand by, something that I give credence to every day on my day-to-day life. I think in terms of trading, it's not a religious thing at all, but it's something that's really just a love. I feel like I have a big love for this game that I fell in love with it at a really young age. The more and more I continue to be involved with it and the better I get throughout the years, the more and more I fall in love with it. It's like I have that one tweet where I say, this is sort of like the NBA for me, because it's true, because the God honest truth is that if you paid me $10 million to go play in the NBA, I wouldn't swap what I'm doing today to go do that, because this to me is like exciting. I see myself doing this for the rest of my life. Like even no matter how much money I may make doing this, it's really, I don't mean to come off cliche or something, but for me, I wouldn't really say it's directly about the money. Now, obviously, if you're a trader, you want to make money. That's the nature of the business. But it's not something that was really completely controlling me on a day-to-day. Obviously, I want to make sure my younger sister is financially well. My mother lives a really good life. I would say those sorts of things are my inspiration. But really, I'm just super happy and I'm blessed. And I thank God every day I'm able to come to the table and partake in this game. There's just so many other people that are not as fortunate as I am to ever have an opportunity like that. So I would say that's probably what inspires me the most is I have the opportunity to do this. And we have great allocators, great investors who stand by us, and a growing fund like ours. Those sorts of things kind of take you back and make you very humbled and grateful and thankful. I would say that inspires me the most.
Well, you do a nice job in laying out some of your thoughts on trading and risk management on Twitter. And I can imagine that younger people who may already be in the business or may just be thinking about it out of college, let's say, are reading some of what you're writing. And so I'm curious if you can share perhaps some of what you would suggest to people who are contemplating a career in markets and finance. What would you tell them about whether it's best practices or things you've picked up along the way that'll kind of get them to a spot from which they can be successful? What advice would you pass along?
I don't really want to speak too much on finance because I've never been in investment banking or something like that. So I can't really give good advice in terms of like generic finance information. What I can do is I could give anybody who wants to be a trader. This would be for the younger group that actually is thinking about being a trader specifically. So the first thing I would say is that this is a career that you're going to have to be comfortable taking risk. No matter how efficient you try to create a strategy, no matter how efficient you try to create a portfolio, at the end of the day, like the risk taker is going to get paid. Same way in a capitalistic society, the risk taker gets paid. So you will have to take risk. And it's kind of funny coming from a guy who bases his entire fund on like tail risk, risk mitigation. But as an alpha generator, if you're thinking about creating alpha and generating profits, which is how you should be thinking about things, you're going to have to go out there and take risks. And you have to be comfortable with taking that risk. And a big part of that comes with understanding that you're going to be wrong a lot in this game. A lot. And the sooner you embrace that, it becomes easier to accept it, and then it changes your trading. I'm wrong so much. I am wrong. So people give me way more credit than I think that they should, because I think maybe my P&L numbers reflect something that's different in terms of like what my actual thoughts are. Because I'm okay with being wrong on something and exiting. And I think that's where people in this business, that's where they go wrong, is they let their ego engulf them and they fall in love with their thesis, or they fall in love with their intelligence and their ego, and it really shows in their trading. So as a trader, if you're able to let that ego go and accept the fact that, look, I'm going to be wrong a lot, and I'm just going to focus on risk. Like I want to control risk. I think that's something that goes a long way. If you focus on, okay, I understand that I need to take risk, but at the same time, I don't want to take risk to a point that it's going to eliminate me out the game. And this kind of goes into the mathematics, and I hate to nerd off a little bit, but when you're thinking about how markets truly function in this like dynamical system, you would never do something like full Kelly sizing to say, okay, even if something is the best edge in the world, I'm going to go max size, because you could be wrong, because markets change. Things are dynamic, so that the time where the edge seems the juiciest and the best in your favor is the time where it could go against you. You could lose, and now you're out the game. And now you're not going to have another shot to come back. Be okay with being wrong. Embrace the fact that I'm going to be wrong. I'm going to lose. Trading's about losing as well. How well can you handle your drawdowns? How well can you psychologically keep yourself in the game to understand, yeah, this is a drawdown period. My trading is still good. The actual discipline and the pillars that I base my trading on is still good, but sometimes markets just don't go my way. Trade didn't go my way. That's okay. I managed my risk. I was fine with the risk I'm taking, and I exited. I'm wrong. I'll attack it the next time it comes my way. There's a lot of that I learned early on. I had to learn the hard way, of course. I took a lot of losses during my earlier days. Thank God it wasn't with significant amounts of money. And I thank God that it happened to me early on, because I can't see anybody managing loads of money without eating those battle scars. As a younger trader, understand you will get hit with those battle scars. It's going to come, but embrace them and learn from them, and understand that this is how markets work. Same way as a boxer, you can't be the world's greatest boxer and expect to never be able to take a punch. It just doesn't work that way. So that's really the best advice I think I could give, is just embrace the fact that it's one of those things that you're going to be wrong on. Being wrong doesn't mean failure.
Well, that's both rigorous and intellectually honest at the same time. So thanks for sharing it. And I also want to thank you for being a guest. I think we covered a lot of ground here. I had a lot of fun. It was great to spend the hour with you. So Kris, thanks so much for doing this.
Yeah, Dean, thank you so much for having me. I really appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.